Hello, college accounting scholars. Welcome back. Hey, we're going to do some practice here. We're going to play with some of the variables associated with selling price and variable cost and fixed costs and tax rates and see if we can identify some what if questions as it relates to some of these specific variables. So here's what I'd like you to do. I would like you to write this problem down and the various equations that are identified on this particular slide. But let's take a what if. What if we want to know the number of units that are sold to earn a $72,000 profit before tax? And we actually know that selling price is $10, variable costs are $4, fixed costs are $600,000, and the tax rate is 20%. So this is a pretty common problem because if you own a business, you usually will have a profit objective. So your concern as a business owner or manager is to be aware of what the break-even point needs to meet that you need to meet in order to make a $72,000 profit. So let's go through the math here. Contribution margin, as you will remember, equals selling price minus variable cost. So in this case, contribution margin would be $6. Contribution margin percent would be contribution margin over selling price, and in this particular case, that would be 60%. The math is relatively straightforward here, 6 over $10. So in order to determine the number of units at a $72,000 profit, what you would need to do is add that $72,000 to the fixed cost. In essence, the relationship here is the $72,000 profit really serves as a surrogate fixed cost because that is your goal. So if you add the $72,000 to your fixed costs of $600,000 divided by the contribution margin, you will get your units, and that's exactly what occurs. So you take the $600,000, which is your fixed cost, and you add the $72,000, which is your profit objective. You divide it by 6, which is your contribution margin, and then you would know as the owner or manager of this business that you would need to produce approximately 112,000 units in order to hit your goal of a $72,000 profit before tax. Okay, again, make sure you've got all these equations down and have a good understanding of the math reflected in your notes. Okay, so if we move to the next slide, we're going to make this particular question a little more complicated. If you own a business and you are profitable, you will pay taxes, which is to some extent an additional cost. So if you want to take home $72,000 at the end of the day, after your taxes have been removed, what do the calculations look like? Well, here again, it's a relatively straightforward equation. You know your selling price is 10, you know your variable cost is 4, you know your fixed costs are 600,000, and you know your tax rate is 20%. Uncle Sam is going to take 20% of your income as income tax. So contribution margin here again is very straightforward. Selling price minus variable cost equals $6. 10 minus $4. Your contribution margin here again is very straightforward. Contribution margin over selling price, 6 over 10 equals 60%. But now we have to make that adjustment for after tax. So the math gets a little more interesting here. You take that $72,000 profit objective and you divide that by 1 minus the tax rate of 20%, 0.2. That equals $90,000. That's the profit that you would need to make before tax in order for you to make $72,000 after tax. So with that in mind, now you do the math of number of units at 90,000 before tax. So you take your fixed cost and again increase those by adding 90,000 to those, and the math would be divide that by your contribution margin of $6. So you see the specific numbers being inserted into the equation here. 600,000 plus 90,000 divided by your $6 contribution margin. That basically yields an answer of 115,000 units that you would need to sell and produce in order to make a $72,000 profit after tax. Okay, let's look at one more. What if we want to know if our variable costs begin to change, and in this particular case increase by 10%, what would we need to do with our selling price to keep our break-even unchanged? And here again, this is a pretty typical problem. Your costs will ultimately change. Your vendors might pass through a price increase, the people you buy your materials from, and if you want to keep your break-even point unchanged, you would want to be able to compute that relatively easily. So here again, your selling price is $10, your variable cost is $4, fixed costs are $600, and your tax rate is 20%. So we do, again, we do the contribution margin, which is selling price minus variable cost. We do our contribution percent, which is contribution margin over selling price, which equals 60%. So now, how do we maintain the same break-even point if the variable costs increase? Well, you want to keep the contribution margin the same. So you take the variable cost and you add the variable cost plus 10%. That's what that equation represents. And your new variable cost is $4.40. So your change in variable cost, by definition, is 40%. I'm sorry, 40 cents. So to maintain the same contribution margin, it's relatively simple math. You take your selling price plus your change in variable cost. That equals a new selling price of $10.40. Okay, so here again, guys, you're manipulating the variables to get operational information, which will better help you in terms of your decision making. This is very common when you own a business and or manage a business, to make these types of calculations and derive these types of variables. Okay, let's quickly review now. So if your fixed costs increase, what happens to your break-even point and your contribution margin? And here again, keeping everything else the same, if your fixed costs increase, your break-even point will increase as well. Just because that is defined by the math, as we've talked about before, break-even point equals fixed cost divided by contribution margin. If your break-even point will have to change if your fixed costs increase. On the other hand, your contribution margin is unaffected by your fixed costs, because contribution margin, as we talked about, is defined by selling price minus variable costs, which has nothing to do with fixed costs. So again, getting an understanding of the interactions of the variables in the break-even point equation. Okay, one last one. What do we want to know here? We want to know if our tax rate increases, what is the effect on break-even point and contribution margin? Well, here again, break-even point is a function of fixed costs and contribution margin. Tax rates are variables which take effect after income has been determined, assuming there is income. So in this particular case, your break-even point would remain the same, and your contribution margin, CM here, as shown on the slide, would remain unchanged. So keep that in mind, that whenever they talk about a tax rate increase, it really does not affect the break-even point or contribution margin, because tax rates come into effect after your break-even point is set and there is income to be taxed. So guys, that'll be it for section 4. Again, make sure you have good notes regarding all the equations which were discussed in this particular section. You will see those equations on quizzes and tests down the line. Have a great night.